So, thank you. Thank you. I'm Mark Schwartz. I lead EY's IPO and SPAC advisory practice. Very excited to be here. It's the first time in a long time that both the traditional IPO market and the SPAC market are open for business at the same time. On the IPO side, nobody can miss all the headlines that are out there. In fact, even if we stop today, or even if we stop at the end of this week, 2026 will have already been the second largest IPO year ever by proceeds. So on the SPAC side, also very clear signs of renewed interest and momentum. 200 plus active SPACs out there, steady stream of announced mergers. And if attendance at this conference is any indication of anything, this is by far the best attended conference we've had in the last 5 or so years. So with that backdrop, and interestingly, with the number of target companies that we see returning to the conference this year, we assembled a top shelf panel to discuss how companies are thinking about the IPO versus SPAC decision. So I think I'm just going to do a quick intro of the panelists just so we can get rolling. Brandon Sun at the end, you all saw him yesterday. Brandon's been around the SPAC product forever. He's often at the leading edge of the SPAC market. He and his team from Cohen and Company. Kareem Anani is next to him. He's my partner at EY. He's been around both the IPO and SPAC markets for 25 plus years. Joel Rubenstein from White & Case, a very practical, very prolific capital markets lawyer. Mark Dressler, an interesting addition to the panel. He's a strategic communications expert over at Weber Shandwick. And we're also pleased to have Michael Pilo from Baker McKenzie, who's also a top shelf capital markets lawyer. So with that, I'm going to kick it right off. And I'm going to start with Brandon over at the end. And so Brandon, from a banking perspective, what are the primary differences you typically highlight to your clients about the IPO and the SPAC path?
Yeah, no, thank you, Mark. So in terms of the decision to go public, for a lot of corporates, it's the most significant event in their corporate life cycle, right? So when we're advising targets through this very critical phase, there's actually multiple options. There's a traditional IPO, there's a de-SPAC, there's a reverse merger, and then there's also direct listing. And I would say one emerging theme is actually there's a fifth category, merging with one of these digital asset treasury companies that have a lot of cash, right? That's another interesting kind of theme that's emerging. I think the way we kind of advise companies through is, look, if your primary objective is speed and certainty, right, nothing beats a SPAC because there's 240 publicly traded SPACs, all with a laser focus to do great deals, right? You have a SPAC sponsor that can validate the story, provide a halo effect, and maybe even bring in capital, right? I think, look, this world we live today is a perfect example, right? If you choose to do an IPO, there's 1,000 companies, publicly filed, confidentially filed S1s in line to IPO, right? Unless you're a SpaceX or OpenAI, right, you're just not going to grab the attention of the various investment banks, right? The various investment banks will tell you, look, they can IPO you, but in fact, look, some of my clients have been delayed for quarters and quarters and quarters, right? So if speed to market is key, right, the SPAC is the best path, right? And I think targets know that. And one of the things we're often happy to do for a lot of these companies is if you want to pursue a dual track, right? Look at an IPO, also tied to SPACs, we're eager to engage and help.
So we're going to come back to dual tracks in a little bit, but Kareem, what types of companies do you typically see attracted to an IPO path versus a SPAC path?
So when it comes to the SPAC path, first and foremost, it would be companies that have a great kind of runway in front of them, a new technology, a new business offering, something that's cutting edge, that doesn't have probably many peers in the public markets, and at the onset of its growth journey. Think about it from, maybe early revenue days in the 5, 10 million, upwards of 30, 40, 50 million, to achieve the valuation that they would like to seek from a capital raise. The SPAC path's a lot better. Traditional path IPO companies can go either way. If you can go through an IPO, you will, or you can choose a SPAC for some of the benefits that Brandon just mentioned. But that's probably a more established, a little bit more on the maturity curve from where the growth is, not the infancy of growth. But growing at a steady CAGR, probably close to 100 million in top line revenue or more, where SPACs in general are smaller sized on the revenue side. I would also say certain parts of the markets, certain industries don't lend themselves well to be marketed through the typical IPO path for one reason or another, and SPACs offer a real alternative to raise that capital and give liquidity to both investors and others coming into the asset.
Excellent, excellent. Michael, when you're talking to companies, are either one of the two types of transactions inherently more risky for the target company in your view?
Thanks, Mark. I think that they just have different risk profiles as opposed to one being riskier than the other. When you look at a SPAC transaction in the pre-listing phase, you're looking at a real risk of getting sufficient capital, and as the folks on the prior panel talked about, making sure that you have a pipe lined up or an equity line of credit or a forward purchase agreement or some debt funding, because as we all know that unless you have like a non-redemption agreement with certain of your founders or other shareholders, the expectation is that most of the trust is going to be depleted. Whereas in an IPO, that similar risk of sufficient capital is backloaded to, it's more based on market volatility, and it's backloaded to the very end of the process where you're ready to be a public company, you've cleared comments with the SEC, and then you're on the road, you're ready to price, and the market doesn't cooperate, and through no fault of your own, your deal's getting downsized, your deal's getting delayed, your deal might ultimately be killed. And similarly, post-listing, I think the risks are downward pressure on your stock, but again, I think the mechanism is a little bit different. In a de-SPAC, you've got the overhang of your public and private warrants that really create a dilution risk that can put pressure on your stock for a substantial amount of time, whereas ignoring the other micro and macroeconomic factors, obviously in an IPO case, a lot of that downward pressure can be based on the lockup agreements and the substantial amount of shares that are locked up that are held by insiders, founders, early investors, which tends to be a much larger component than are locked up in a de-SPAC transaction. And IPO lockups have gotten shorter and shorter, which makes that pressure happen sooner and sooner.
Got it. And so one of the primary reasons why a company seeks a listing oftentimes is for branding and publicity. And so Mark, I'm going to kick it over to you. Is it even possible, in your opinion, to create the same marketing buzz around a SPAC deal as it is in an IPO?
Yeah, I think it's possible to create the same type of buzz, but I think you need a different playbook for a de-SPAC transaction. Let me talk a little bit about what we think in the comms world is sort of the ultimate currency, and it's really attention, right? If you think about sort of the attention span of each one of us today, we all scroll through about 350 feet of content each and every day if you would print it out on a piece of paper. So the attention span in the markets is very, very limited, to say almost non-existent. And you see on the traditional side, oftentimes companies that have done a good job of building brands, right, prior to a deal. You see it with SpaceX right now, OpenAI, everybody else that people are excited about. I think the challenge on the de-SPAC is when you have the deal and you announce the deal, that is oftentimes a completely unknown company with a completely unknown management team, And I would go even further. Oftentimes, it's foreign issuers that come to the market here with a very limited footprint, even in the country. So how do we actually make these folks relevant? That's number one. How do we build an investor relations function early on in the process? And I think the other thing is, how do we train the executives to engage with the capital markets here? And we see that not only with the capital markets participants, but also the media. And oftentimes, these companies don't even have a website. They don't have a LinkedIn profile. They are not used to all the communications tools that we all gravitate towards. So you need a partner that can actually build these things very quickly from the ground up and has the experience and scale to help these firms. And that's how we actually engage with them.
Any best practices you can think of on the SPAC side for some of these companies?
Yeah, I think what we like to do is, kind of follow what we call a paid, earned, and shared strategy. So we really go through each communications channel and look for, where are the holes, what are the things that we can do. The other thing is, I think, management training exercises. We actually have a relationship with the NYSE where we take management teams to the studio and we practice, how do you engage with media, how do you do an effective listing day so that you actually, practice this in real time with the real thing. I think that brings a lot more confidence to these teams and teaches them to be on message, of course.
Thank you. So Joel, let's head over to you. Oftentimes when we meet clients, they hear SPAC, they know what they read in the paper. Oftentimes it's not all that favorable. In today's day and age, after coming through sort of tough times, getting a little bit better, et cetera, when you meet clients, are you still seeing them come to you with some sort of an air of a taint around the SPAC transaction?
So I think it really depends. There's no question, if we're all being honest, there is a pervasive view among certain people. I mean, we had one company that we were talking to, and they said, kind of in the lines of this panel, they were thinking about either an IPO or a SPAC. I said, well, that's going to be a different set of people probably you're going to talk to generally. And he wanted an introduction to sort of top-tier IPO underwriters. So I called someone at one of the big banks and said, I have this company. So we set up a call. So I get on the call, and they have their IPO team on. And I said, here's this company, and thinking about an IPO. Well, they actually came to us originally talking also about a SPAC, and I saw their faces were all like, just scandalized. I felt like they were they were like, oh, well, So you have that, and that pervades, right? But like, I'm almost reminded of the story that Malcolm Gladwell tells about Joe Flom in the 60s when there was a company that was thinking about doing a hostile deal, and there were some lawyers in the room from a white shoe law firm, and they're sitting there, then the topic turns to that, and then all of a sudden they said, okay, someone's gonna come in, and then Joe Flom comes in, famously of Skadden, and they start talking about the hostile deal, and Joe Flom's got it, tells them exactly what they need to do, and then he exits the room, and like the junior person at the white shoe law firm turns to the partner and says, we could do that too. And the partner looks at him and says, we can, but we don't. And I think that you have that sort of pervasive attitude which persists, here. Over time, of course, what we saw is that hostile deals today are completely normal, and this is the way certain deals are done, right? Sometimes it's going to be consensual. And I think really with the SPAC market, what people don't always, what people lump every single deal into, that's a SPAC deal. And the fact of the matter is, if you look at IPOs, there's a whole range of IPOs going on. You have, obviously, SpaceX, and then you've got some tiny company that you've never heard of, that's going public through an IPO and will perform poorly, but somehow those don't get linked together in the same way. So I think, look, people, for their own reasons, persist in doing that. I think you have to look, and most clients, what I talked about them is say, look, you have to take every single deal, analyze it in and of itself. If your company is ready to go public, if you can find investors, then do it. But don't but yes, don't be tainted by the fact. Don't be convinced by the naysayers out there, because there's plenty of deals that you can look at that have been super successful. So, answer your question, yes, we certainly still see it, but I do think that when people look into it more, they recognize that it's really not a monolithic market, and you can differentiate between the deals.
Great. So, Brandon, valuations obviously matter tremendously to target companies. How do valuations differ in a SPAC deal versus an IPO?
Yeah, no, it's a good question. I look at the IPO product slightly different from a D-SPAC, right? At the core, the D-SPAC is more of an M&A deal, right? You're negotiating a set of circumstances that reallocate control back to the founders, back to targets, right? I'll give you an example. If you do a regular IPO, you hire a bunch of banks, they're going to genetically engineer the valuation to trade up, right? Unless the valuation's so attractive where they could raise a lot of money, where they make money, right? They're just not going to IPO you, right? Whereas a SPAC, right, you could do a lot of different things, right? Where you could tailor around value, right? Give the management team a big earnout, right? You could recut value during a pipe marketing process. Even actually announce a deal, you could still revalue the company. Circle actually value the company higher, right? So for example, a lot of our companies, right, they look at this as really kind of a tailored way going to market. Webull, right, it's a $5 billion company, right, backed by the Sequoia and Hill Houses, right? Goldman Sachs was their IPO book runner. Just wouldn't IPO them for 3 years, would not take Webull public. Because they had a little bit of hair, right? Some of their founders were Chinese. We found them a great SPAC, the SK SPAC out of South Korea. We took them public, which is all they wanted. They didn't really need cash. They had 100 million EBITDA, right? For them, that certainty was powerful, right? But if you want to do a more traditional IPO type of deal, we buy Xanadu, right? We took Xanadu, a $3 billion quantum computing company, public, helped them raise a $275 million common equity pipe at $10, right? So that's the beauty of the SPAC product. You could do whatever you need to fit the needs of the team.
So, Brandon, what do you say to somebody who says, an IPO market, you have an IPO discount, it's priced to trade up? In a SPAC deal, you may have PIPE investors come in at a discount. Perhaps it's priced to trade down. How do you rebut that?
Yeah, no, again, that's another one of the beauties of the SPAC capital raise, right? If you need to raise capital, it's not only valuation that's a toggle. You could actually toggle the PIPE instrument too. You could have a $10 common equity pipe. You could have an $8 common equity pipe, right? You could have a pipe in a convert format. For example, earlier this week, there's a company called Quantum Space that raised $300 million in a convert, right? A couple weeks ago, we raised $200 million for this company called Pascal in a convert. So you can actually tailor the instrument to fit the needs of the company. We were talking over drinks a couple of years ago. We actually raised a common equity pipe at $12, right? So depending on a deal, you can actually do a lot of different things, even with the capital raise.
Excellent, excellent. So, Kareem, obviously at the end of the journey, all these companies are public companies, regardless of the path. Do public company readiness efforts differ between the two paths?
Ultimately, not really. The amount of rigor that needs to go into building your operational readiness in the different verticals of a company, from finance to legal to IT, cyber, FP&A, controls and the like, is one and the same. The difference really is whether the company, under today's rule, qualifies as an emerging growth company or not. Most companies going through the de-SPAC process qualify as an emerging growth company or even a small reporting company. And that means the level of disclosure and what they need to do is a little bit less onerous than your typical kind of well-established public company. But the journey more or less is the same. The amount of effort that the management team needs to put into it and the level of seriousness that they need to take is identical. And ultimately, you can have a great story and a great product and a great vision, but if you don't have your internal house in order and you don't have your operations set up to allow the company to behave and report as a public company, you're going to falter in the public markets. And so it's imperative that as much attention comes on the deal side early on as there's an investment in the internal build. So you match the story with the success of the operations.
Brandon, just back to you. When on this public company readiness, when a company comes to you and/or a SPAC sponsor, how important is their state of readiness to the ability for them to transact?
Yeah, I'm a little bit more avant-garde in this kind of thought process, right? What I really care about is a laser focus from the target, right? Sometimes the twinkle in their eye, sometimes their set of circumstances they're dealt with, right? Yet they need to be public. They will be public at the end of 6-9 months, right? Really, all they really need, truly, is just 2 years of PCOB audits, 3 if they're 100 million revenues 3 years ago, right? That's really a long pull, right? That takes like anywhere from 2 to 4 or 5 months, depending on who the auditor is, right? All the public readiness stuff, right? They can figure out, right? 6 months is a lot of time, especially if you have a great team, great help like Kareem and Mark who could parachute in, right? Get them ready, right? So I do think as long as the target's focused on it, the public readiness stuff they could figure out. The number one priority is an intent to go public.
Got it. Got it. So, Mark, back to you. One of the biggest differences that we see typically with an IPO company coming out is it's got a broad syndicate of underwriters. It ends up with a broad syndicate of research coverage on the back end of being public. From the SPAC perspective, oftentimes you see companies with, I'll say, meaningfully less street coverage. Any thoughts on, I guess, ways to continue to evolve that, especially in the SPAC context?
Yeah, thanks, Mark. Yeah, I think that's a real advantage of traditional IPOs, right? That you have the syndicate, you auto-enrolled in coverage, right? And you have that. And I think, for companies that come to the markets through the de-SPAC process, they really have to build a robust investor relations function right from the start. And I think that panel before actually mentioned that. I think it's a real issue for companies because you have to do so much in parallel, right? But you have to build that up. And it helps if you have a pipe, right? Gives you credibility. But it really, you need to knock on doors and do the work to get coverage. And I think even in the small cap universe, I read something that 42% of companies today have zero coverage. So coverage is a huge issue. Build up a robust function is number one. Number two is, oftentimes, IR is a little bit outsourced. I'm not against it, right, on the vendor side in that sense, but having somebody right from the start that an IRO on board actually does help, right? And it helps you with investor targeting, post-IPO. And, somebody once told me, a good IPO is a promise, a great IPO is a promise kept, and you really have to keep the promises that you make. And, we talked about mock earnings, we talked about all the things that you can prepare, and that gives, the street and analysts confidence, right, to cover you, but you got to earn these stripes.
And not to keep picking on you, Brandon, but does it really matter if a company is well covered by the analysts?
I think some initial coverage out of the gates help, right? I think right after you close, if you have 2 good research analysts, 2 good thought leaders, that's probably enough, right? And over time, you want to be able to kind of build and develop your story, right? And I think also what Mark said, having the right analysts that you want to curate is really, really helpful, right? Like, for example, USA Rare Earth is a company we took public, right? Instead of getting traditional metals and mining guys to cover the story, right? At each of the research houses, they actually did months of work and found more to tech leading analysts, right? Could value this more on forward growth story. Look at it like a SpaceX or a semiconductor type of deal. So I actually do think even that process is helpful, right? Instead of being forced to have analysts by 5 different banks, right, just because you paid them IPO, figure out who the right analysts are, make that decision over time, and make a very surgical and precise decision.
Yeah, got it. So Kareem, I know you and I are seeing a whole bunch of companies, I'll say, preserve their options around that dual track process that Brandon brought up in the beginning. What are the typical instances that you're seeing that type of process get run?
So if you're preserving both, like if you have the option to go, whether it's the SPAC route or the IPO route, you kind of get a free look by going the SPAC route. You can do it you can do it confidentially. You can put your market feelers out there and really kind of see what kind of reception there is. And it's kind of like a test the waters in an alternative universe. So I think that opens up the company's eyes to what the art of the possible is. And typically, if you can go both paths, it's worth exploring the SPAC path first, see if there's any interest. And there's some guarantees, like you said, Brandon, on exit. You can raise the pipe, there's committed capital. You can engineer the deal with earnouts and the like. You don't have the ability to kind of financially engineer a deal in a traditional path IPO. Also, even if the IPO path was available to you, you're 6-9 months out, and if that window closes, the market says they're not ready, you can't go. You can close a SPAC deal in any market, whether you got the committed capital. So I think that's the way to look at it. Interestingly enough, we are seeing we are seeing companies today that have always wanted to go down the traditional path and say, wow, the SPAC market's back. There's some really good quality sponsors. There's guaranteed capital. There's bridge financing that can be extended in advance of a close. So you're really pulling forward kind of cash commitments and capitalizing the company through different types of vehicles. That might be more appealing and say, okay, we're going to file confidentially, or we're filed confidentially with the SEC on our first DRS filing. Here comes a SPAC, and yeah, let's explore it. So you can dance between both. Ultimately, once you announce a deal, whether kind of it's a SPAC or you flip public, or it's very well known that you filed confidentially and filed an 8K that says you filed confidentially for an IPO, the cat's out of the bag and you've kind of committed to one route. And so kind of holding and preserving that optionality and using that to the company's advantage should be something that is explored more often. It isn't done as much as I think it would be done. And there's there's somewhat of an arbitrage play here of like what's better or what suits me better. And it's just not really kind of in vogue. I suspect we'll see a little bit more of this come together more.
Joel, I know you're seeing this as well. So how do you counsel companies on maintaining flexibility for as long as possible, sort of when they need to make decisions in those processes?
So if a company is talking about this, obviously it's got to be a company that realistically thinks it is possible to do an IPO. There are technical things you need to consider because, as has been talked about by, I assume, every single panel here, one of the big differentiators of the SPAC is the ability to potentially get a pipe up front, right? And there can be issues if you market privately a pipe and then you want to go to those same investors publicly later, that can be an issue. So I think that most of the companies that are considering that are basically saying, look, if I can raise a substantial pipe, get that money certain at a certain valuation up front, I'm going to go that route and not take the risk of the IPO. Because again, by definition, if it's a company that could definitely do an IPO in any market conditions, they're probably doing that. And so you're already talking about a company that may do that. So I think what we normally counsel people to do is go in front of a few potential pipe investors, see if you're getting traction before you go really broadly so that you sort of could potentially take people out. And then if you see that traction, then, sort of go further with that, go forward. In that, what Kareem said is right. Obviously, once you announce a SPAC deal and you've signed a deal, then you're not going the other route. But I think that it's really testing out whether the pipe is there. And again, like one of the things that we've seen in IPOs in the last few years is a concurrent private placement, which has been a little bit that was addressing the pipe phenomenon in SPACs, where you'd say you have money certain, so people said, oh, you can do that in an IPO. You can also get these commitments to pipes that you see close. The difference being, and the key difference being, is that generally those are based on the IPO valuation, and often at some discount to the IPO valuation, 5%, 10%. And so, again, it's true you can get potentially certain capital, but you wouldn't necessarily know what the valuation is, and the SPAC will give you that valuation. So again, I think you go down that route, see if you have a strong pipe, and then I think you see if people see the pipe really getting traction, they'll pivot to that and then leave the IPO on the side.
Yeah, and Joel, in addition, I mean, we traditionally see pipes, and that's how this market's worked. 5-6 years ago, you saw the advent of backstop agreements. They went away. We're starting to see sizable backstop agreements being reintroduced to strong deals. So that's another kind of advantage SPACs have, and it would be remiss for us not to mention that that's back in the market today. We haven't seen backstop agreements in the last 3 or 4 years,
Right.
but they're back.
So Brandon, one of the, I'll say, knocks against some SPAC deals are the low float situation, the illiquidity in the stock. Are there ways to go through the SPAC process to sort of mirror a more typical IPO float type situation?
Yeah, no, absolutely. Like I would make an observation though, right? If the target, right, fundamentally is exciting, it captures eyeballs, it captures imagination, it will trade well, right? You look at NewScale, Oklo, and SMR space. You look at MP Materials, USA Rare Earth, and Rare Earth space, right? There's IonQ and Xanadu in the quantum computing space. They all trade a ton, right? Hundreds of millions of dollars of volume a day, right? For the typical D-SPAC, right, that might not have that they want to appeal, I actually think going public through a SPAC and cultivating a float is actually not a bad thing, right? Everyone naturally thinks a lot of float's good. I actually argue the other way, right? If you have a younger emerging company, right, you actually don't want a ton of float. You don't want a ton of volume and selling pressure, right? You actually want to develop that float slowly over time, right? Increase that flow through good IRPR, like what Mark said, right? Have catalysts that come out, right? Prove to the market, look, you could hit your quarters and hit your projections, right? And grow that flow with time, which will come with capital raise. So if you look at a couple of these D-SPACs that did well, they actually execute this playbook, right? By having a limited flow, right? They were able to manage a share price and grow both their share price and their float.
Awesome. So getting close to time, in 30 seconds or less, I'm just going to go down the row, starting with you, Michael. When companies are considering this decision, what do they most often get wrong in their thought process?
Well, in terms of sort of making that decision in terms of IPO or D-SPAC, I think there's a market perception that folks who go the D-SPAC route are not public company ready, and that's sort of layering on to what my friend Joel and others have said. And the reality is that there's plenty of IPO companies that aren't public company ready, and I've represented some of them and fundamentally knew that they were not prepared and were pushing forward. And it's not about the path you take, it's about preparing and having the public company readiness.
Yeah. So for me, it's two things that I see. Number one is, I think a lot of folks confuse sort of the IPO finish line with this is kind of it. No, that's when life as a public company actually starts, right? And you got to prepare well ahead in terms of, you know, your first earnings, all of the other things that are necessary as a public company that you need to do, also from a branding perspective. The second thing is, and I'm not a big fan of the word stakeholder, because this whole notion that there are different stakeholders goes against the speed of communications today, right? If you look at, you know, if you're at a conference and, you know, you say something to that, on a panel or something, and then you look at a fireside chat and, you know, the IO says something different than the PR folks, and the management team says something different than the board, you see that being picked apart, and it's being picked apart by activists. That's like, I call it almost like activist bait. So message discipline integrated across the board is key.
Great.
I would say a couple things. One, at the term sheet stage, you'll see a lot of companies trying to get a high valuation, negotiating with the SPAC for a high valuation, and they're not negotiating with the right party, right? The elephant in the room is the investors, right? So the SPAC can tell you, oh, I'll give you your $2 billion valuation, but it could be completely disconnected from reality, and I think people get very myopic in this negotiation, thinking that they're negotiating with the right party, and the fact is the SPAC is a vehicle. And in the end of the day, you're going to have to get the investors. And I think, similar to that, I think that at the outset, you really have to think through not only how you're going to start the process in a de-SPAC, but also how you're going to end it, how you're going to satisfy the float, how you're going to get everything done. So I think it's really, again, not thinking about each stage myopically within the stage, but really thinking about it all the way down the road to the closing. What do you need to do to get closed?
I'd say you mentioned, Mark, that there might be some taint around the SPAC market. You've got to look at each deal kind of on its merits, and I wouldn't just discount SPACs right off the bat. In fact, certain companies are way better off going through the SPAC route and kind of exiting, through that vehicle. You just have to ensure that you have a well-engineered, well-thought-out deal with the right amount of capital, with the right amount of float, and the economics that made sense. To Joel's point, if you just kind of throw out the number out there, that's just hypothetical to appease people, it's not going to trade well, you're not going to attract the capital. So if you actually engineer, my thinking is if you can actually engineer the SPAC deal properly, you can probably come out with a better outcome than your traditional path IPO, because you'd have achieved not the valuation only, but the float and the carriage and the investment versus taking an IPO discount and seeing how it trades post-close at the point in the future, whether or not the market is available to you. Brandon?
Yeah, my advice to a lot of companies, right, boards, management teams, look, a lot of times they're scared, right? They are slowed down by inertia. My recommendation, just to start, talk to a few SPACs, engage in a process. Look, it's a free option, like Kareem said, right? I think the biggest thing is, look, status quo is a conscious decision, right? If your sector is getting disrupted and your comps are going public and raising a lot of money, and you stay still, that's a conscious decision, you're going to be left behind, right? So in this hot market where there's a massive public-private arbitrage, I'd recommend action.
So I think we're the last folks before the break. We'll take questions, I think, offline, and I know we're over. But special thanks to all of you. Really appreciate it. Thank you to you as well. So thanks.
Thank you.
Thank you.
Thanks, Mike.